Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor to wealthmanagement.com's RPA Edge. I review all of last week's industry stories and select the 5 most important ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story is Vanguard has agreed to indemnify Massachusetts investors and pay a fine to state regulators totaling $6 million based on outside capital gain taxes retail investors paid in their target date funds as a result of shifting them into institutional share classes. Mass Secretary William Glavin had also sent letters to other top target date managers like Fidelity, T. Rowe, American Funds, and BlackRock. With over $1 trillion under management in their target dates, $6 million is not much to pay. But the question is whether Vanguard will have to settle with other states and the SEC. Next, the job market cooled a bit in June with just under 400,000 new jobs added, just below the 3-month average and well below the 12-month average, but in no way is the job market cool. Unemployment at 3.6% is still near record lows, and hourly wages rose 5.1% year over year. Hiring was robust in most sectors other than with government jobs, led by travel and leisure, and the massive airline cancellations have been blamed on the lack of personnel. Though some high-flying tech companies like Netflix and Twitter have announced layoffs, there were 25,000 new jobs added in that sector alone. This job report is expected to keep the Fed on track to raise interest rates an estimated 75 basis points. Third story, another week, another lawsuit. This one filed against Northeastern University with the usual claims, but it looks like there's a new law firm in the fray called Fair Work, based in Boston, representing employees exclusively. They cited the Hughes Supreme Court case alleging that some investments were not prudent, even though many of the 60 others were. High record-keeping fees, hidden revenue sharing, lack of required RFPs, and the failure to renegotiate for lower share classes were among some of the allegations. Look for other law firms to enter the growing DC lawsuit industry with copycat lawsuits against small plans and targeting advisors who are getting larger and are starting to sell ancillary services in a non-fiduciary capacity. And the next story, the question is the golden age of private equity investing over? There's higher interest rates, which makes loans more costly, lack of IPOs, so it might get harder for them to raise money. Add to that, the average price of portfolio companies is 14.6 times EBITDA in Q1, up from 11.9 times 4 years ago and 12.8 for publicly traded companies. And as pension plans and endowment funds sell off stocks and bonds, their allocation to PE funds may also decrease. Yet family offices and high net worth investors seem to be ready and willing to step up, with research showing that 75% of family offices believe that PE firms will outperform the public market. All of which is important because PE firms have fueled the consolidation of RPA firms and record keepers owning or having a stake in Captra, SageView, Hub, One Digital, and NFP, to name a few, as well as Ascensus, Alight, and PCS, and are rumored to be interested in buying or investing in a few others. Not to mention the venture capital backing of the growing fintech record keepers. Finally, Though there is much controversy about digital assets and DC plans, don't confuse it with blockchain, which made cryptocurrency possible and could dramatically improve DC plans, especially helping and servicing participants, relieving many privacy concerns. Blockchain uses a tamper-proof digital ledger available across networks and accessible by permission, adding new data safely, which could lower costs by eliminating middlemen needed to verify transactions. It could also help with leakage by aggregating retirement accounts and might be able to facilitate retirement income services. There may also be greater cybersecurity protection. But don't expect blockchain to affect the DC market anytime soon, as change, as we know, happens very slowly, impeded by regulators and record-keeping systems built on 1990s technology. So those were the most important stories from the past week. I listed a few additional ones that I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking to you next week on 401k Real Talk.